Hello, all you lovely people out there. How are you all doing? I'm Kate Hill, and I am here to give you the best commentary about our property markets. Tina Howes is with me from SmartMove, one of Australia's leading and award-winning mortgage brokers. We are giving you a whole series explaining all things property finance, so stay tuned. Hello everyone, and welcome back to Tina and mine videos series about property finance. In a previous video, we talked about deposits and lenders' mortgage insurances and options for getting your hands on more cash. And Tina talked about a little bit about the options of, or the possibilities of using a parental guarantee. And we thought we would explore that topic a little bit more. So Tina, talk to us about parental guarantees, and can people borrow more money when they have a parental guarantee? How does it all work?
Okay, all right. So it's very common that people will come to me saying, "Oh, mum and dad are prepared to give us a parental guarantee. So can we borrow more money?" Now, a parental guarantee is essentially when a parent uses their security property to help make up a difference and a gap in your deposit. Okay, so it's basically providing supporting security to assist your children to get into the property market sooner. Okay, it's designed to help clients that potentially have a small deposit. And the key point that I want to reiterate before I go into sort of who's eligible and so forth is the children still need to be able to afford the loan in their own right. So when I say afford, I mean their income, their borrowing capacity, and their serviceability, which we uncovered in a previous video, still needs to be able to cover the loan. Okay. So if I say to you, you can borrow $1 million, that's the maximum borrowing capacity. Mum and dad guaranteeing your loan does not mean that you can then go and borrow $1.2 million. Okay. It's purely a mechanism to avoid paying that LMI, mortgage insurance, that we touched on previously.
Right. Okay. Right.
So in terms of who is eligible and what parent, what's the typical criteria? So there's some key points. So generally we want to have mum and dad with a decent amount of equity in their property. They want to be at a stage of life where they've pretty much paid off a mortgage or only have a small mortgage left. They want to either be a self-funded retiree, so not on the government pension, or they want to still be working. Okay. The key point is if you were unable to pay your loan and mum and dad needed to step in and were called on in that guarantee, we don't want them to be put in a financial hardship situation where they're kicked out of their home and basically got nowhere to live.
Is this just for the deposit part or for the, let's call it the 80% part of the loan?
So that, I guess that's a point onto the structure of how these things work. Okay. So generally speaking, if you bought a property, you can borrow, and let's assume you've got the borrowing capacity, income, all of that is there for you to be able to purchase this property. Okay. But based on the deposit that you have, you could essentially only borrow $900,000 on a $1 million purchase. Okay. And you only have $100,000. I say only, but you essentially need, you've only got the 10% deposit. You essentially need to come up with an additional 15% to cover your costs and that other amount to get below the 80%. Okay. So your two options are you can pay mortgage insurance, or if you have a parent with a property that they can help and they meet that criteria, they can provide that property as security to cover that shortfall of the 15%. So you borrow all the money in your own name. The bank still takes security of the property that you're buying and they lend the 80% against that property. But then for the additional property, they basically, part of your loan, the 15% will be against mum and dad's property. Okay. Now, every bank's a little bit different on how they structure it and whether the parents secure both loans or whether it's just against the guarantee amount. with some interest in there. There's all a little, a few nuances across it. But essentially, in a default situation, if the bank was to sell up your property, and if they didn't get, so in this example, if they sold your $1 million property and they were able to repay the loan, happy days. Problem. But if they didn't get back the money that they had lent you, then that shortfall can potentially be claimed back from the parents or negotiated with the parents to take out a loan to help pay that back.
Okay. So you obviously, all parties really need to be aware of what risk they're taking there. So is this quite common at the moment?
It is quite common.
Finding that's quite a bit,
particularly at the stage that we're at in the cycle. For the parents that are seeing their children having to pay ridiculous prices to get into the market to buy a house. Chances are we've had a significant growth in the property market over the last 20, 30 years that mum and dad are probably sitting on a large amount of equity that they may not have the cash to gift to the children. They may not have passed away because they're not at that stage of life. So there's the inheritances aren't flowing through yet, but now is the time where they want to help their kids, and a parental guarantee enables them to do that. Okay. So in terms of key points that to keep in mind, the aim is that the property continues to go up in value. At the same time, you're making principal and interest reduction repayments on the loan to the point where hopefully in a couple of years' time, you're able to revalue your property and the loan that's left over is under 80%. And you can therefore release the parental guarantee.
Yes. Mum and dad can breathe easy again. And
another key point, often parents will be concerned that, we've got 3 kids. If I do it for one, then I'm not going to be able to do it for the next.
Just going to come to that. Yes.
Okay. That is something that you can actually, as long as there is sufficient equity in that property, that it can be done again and again.
And I'm guessing that the parents' borrowing capacity, see earlier video, everyone, that there's going to be some sort of calculations done by the bank that the parents can then service all those loans for all those kids that they've
to be honest, there's a handful of banks that do want to make sure that mum and dad can pay their guarantee portion, but there are quite a few lenders that don't require mum and dad to be able to service it.
So they'll just go by the value of the property that's being used, will they?
Yes, but they're ensuring that you can afford the loan and service it.
Yes, of course,
Okay, so they're making sure that you have sufficient equity in that property as a parent. And that can service their own debts.
Yes.
Okay, but in terms of the parents, if they're sort of not at that stage of life where they're done borrowing money and done investing, it is important for them to note that if they do then want to use their house as security in the future, that it can potentially impact upon their borrowing capacity.
That's right.
Because it is highly likely that any bank wanting to lend them money will want to know about the loans that they have provided guarantees for, not just from a security perspective, but potentially from a cash flow perspective as well.
So again, more morals of the story is the planning ahead, looking at the future of what you as a family might
absolutely
be doing.
It's quite common that parents look at this process, and mum and dad essentially need to do an application very similar to you as applicants. And a lot of parents may have residual lines of credit, residual cash left over, and may prefer to control that process and end up gifting or loaning the children money.
Yes. Okay, and all that just to avoid LMI, I guess. See that video too. Yes. Okay, well, thank you, Tina. Very informative as always. It never ceases to fascinate me, all this stuff, as you can tell. So we have got lots more topics for you that we'll cover off in the coming months, and we will see you all again soon.
Thanks, Kate.
Bye. I really hope that you found all of that useful. Tina is a mind of information. She and I will bring you lots more videos explaining all things property finance. Don't forget to leave us a comment and a question. And don't forget to hit the subscribe button, and also just give us a little like on the video if you are enjoying the free content. And we will see you really soon. Bye.